One of the things that struck me, first and foremost, is that the Fed is keenly watching the markets. They know what is going on, and their little Fed pop-offs are definitely, in my view now, orchestrated. So it's not just random. They are doing these things to test the market, and they're looking to see what the reactions are when they do them. That seemed quite evident. So let's begin here. There were a couple of things that struck me as key in their statement. Of course, there's an overall theme with the Fed, and it seems to be that they know things are weak, but they won't say why they're weak. They don't really want to call out, I think, the federal government for a weak fiscal policy. So they kind of push it off. Anyhow, they basically, out of the criteria that they watch, and I follow four of them, they put the GDP risk being to the downside, which is bearish, the global risk to the downside, which is bearish, but not, I shouldn't say bearish. Let me go back. GDP risk to the downside being more dovish, global risk to the downside being more dovish. They say the employment risk is to the upside, which would be more hawkish. But keep in mind, these Fed minutes were before that abomination of an employment number, although we know that Loretta Mester, who I'm now calling mean red, seemed to think that they were pretty good. The numbers were not good. They were a very large miss. And then they talk about the inflation risk being to the downside, and then they mention that there's always shock risk. They will talk about household spending being up. That's always the drunken sailor metaphor. But they talk about business investment being low, and that, I believe, is due to regulations. Obamacare being one of them, the EPA being another. They also cite the weakness in oil prices or energy prices as being one of the reasons for lack of investment with drillers and so on and so forth. But they did mention that they're seeing that stabilize. Speaking of oil, as a quick caveat, we had a bearish inventory number today in oil, and it went down fast and then just ripped. So as long, in my view, as oil can hold the breakout over the last peak, which was 49.33, if it can hold over there, the risk, in my view, and I've said this in my last few videos, that the risk in oil is to the upside. The OPEC, they're doing an OPEC meeting, and I just don't see there being a huge downside in oil if OPEC is going to cut, or at least people think that they're going to cut. So today, the low of day it didn't even fully get there. It was 49.36, and then it basically closed almost near the high. If we lose 49.33 and like our low of day, and then really 49s, let's keep it real simple. If we lose 49, then I think we're looking at like 45s, 46s, but I don't really see a ton of downside in oil right now. I just don't, not with that OPEC information coming up. Here was an interesting tidbit. The Fed, through 2016 through 2019, they're not changing their GDP expectations. But they're expecting some kind of a pickup in consumer spending and business spending, which seems very fanciful. So if they're not raising their GDP expectations, and we know that they don't think their inflation expectations are changing to reach the target rate for another 2 years or more, why would they be raising rates? It makes no sense that they wouldn't reach their targets, their end targets, and if anything, growth is slowing, and they're worried about shock risk. Why would they want to hike interest rates? Someone asked what will bring growth. So my answer to that is very simple. You have to incentivize. It's actually not really so simple, but I'll give you the short version. Make it more advantageous for businesses to grow their businesses, not just buy back stock and pay dividends. Give them visibility in terms of regulations. Give them visibility in terms of policy. Remove some of the strangleholds that have choked off business. A lot of regulation, like Obamacare and stuff, has kept the average hourly work week stubbornly below 40 hours a week. It's around 34 and change. That's because companies are circumventing the Obamacare tax. They're keeping workers part-time. So that would be one of them. I think that would help with the average hourly wage. I think that would help quite a bit if if businesses had certainty to do this. The lowering of taxes, corporate taxes, is the highest in the world. We are bar none the highest, and capital flows where it's best. And regulating companies to not offshore and not do business overseas is not going to be the solution, not in a global economy like we are in now. It would be to lower taxes and to incentivize businesses to move here. Repatriation of foreign monies. Tons of companies have foreign balance sheets, and they're keeping all their money there. I'm not saying just allow companies to bring it back without any penalty. There should be maybe a small one, but maybe incentivize businesses to hire American workers with that money, and they would get tax credits or tax breaks or not have to pay the tax on the repatriation. That, to me, would be a bonanza of money coming back into the U.S., which could be used towards projects. Keeping the interest rates low, I believe, has been a tool for companies and countries to de-lever balance sheets and in order to offset some of this horrific policy. If you have a lower hurdle rate, I don't want to get too into the nitty-gritties of valuation here, but I do have a nice spreadsheet actually from my alma mater at NYU that will be in the description of the rebroadcast of this video on YouTube, and it deals with the weighted average cost of capital. And if you keep interest rates low, projects that you could normally not do profitably can become profitable. And in addition, stock PE multiples should trade at a premium as long as the weighted average cost of capital is low. I've proposed, and I know I'm going off on a little bit of a tangent here, but I think it flows in very nicely, that companies have been doing this kind of upside down type of a situation where they've realized interest rates are so low and they could borrow at rates that are almost as good or in many cases better than what governments can borrow at, and they're restructuring their entire capital structures to boost their share prices. If you can borrow cheap, load up on the debt. I mean, this is fixed debt at historically low rates. So companies like Exxon, companies like Apple have been doing this. They've been changing their capital structures. You usually get worried about companies when they take on too much debt, but with the amount of interest that these companies are paying, I mean, they can earn their way out of it very easily. I mean, it's really this is kind of, like I said, a bizarro world we're in here. One of the things that the Fed mentions, and this played into one of my big themes, they paid a little bit of lip service to this, but they mentioned that manufacturers are modernizing over hiring. That should be alarm bells to anybody who listens to my broadcasts. That is AI and automation. Bingo. That is going to change the world forever. The world, I don't mean to sound too dystopian, but the world as we've known it for years and decades, and the last 200 years or so in the United States, is over. We are in a technological revolution now with artificial intelligence and automation, and that is going to wreak havoc on the employment situation. Would you rather have a bunch of people demanding more health care? Would you rather have people demanding more hourly wages? Would you rather have people demanding more maternity leaves? Would you rather have more people demanding more safe spaces? Getting my drift? It's a lot cheaper to deal with AI and automation after the initial investment than it is human capital. And I know from running my own business for years and years and years, at the end of the year when I'd be at my accountant, payrolls and staffing and so on and so forth was always the most expensive input cost. And if you can lower that, you'll do amazing things to your company's bottom line. In the end, of course, it's bad for the economy because you have a huge spike in unemployment. But the Fed seems to be maybe waking up. They're finally smelling the coffee. Time to make the donuts. They're watching oil closely. I've mentioned that the data came in softer, and they mentioned that investors thought it came in softer. The rate of change in terms of the job pickup they noted is slowing. I've mentioned that as well. There seems to be a bit of a conundrum in the Fed where they talk about the CPI over PCE. I don't want to get too into that here. Let's see. They talk about employment. There's room for growth without wage pressure. I mean, no shit. Sorry to be so blunt, but when your daughter's bringing home a carnival ride operator and his job is considered the new doctor, it's a problem. There is really very little wage growth. People, in many cases, when you factor in what I call, I don't want to say screwflation. I've heard that term used. It's not my own, but I've heard it. Healthcare costs going up, just the cost of average day living that doesn't necessarily hit the Fed's radar, although they are following it more than they have in the past. But food pricing has come down, so it's sort of a push. There's really not all that much inflation. There's no pressure on the Fed to hike in that scenario. They talk about lower productivity. They blame this on lower productivity, demographic changes, and excess of savings, that people are saving too much. That would be because they don't have a lot of money. I think most Americans don't even have $1,000 worth of savings. It's actually really quite scary. I'm just going through some of these notes. They talk about the interest rate being to the lower bound and the decline in productivity growth. They say that the issue could be structural, which is the big nightmare of the Fed because they can deal with business cycles. They can't really deal with structural issues. I'll get into that in a minute with regard to the bear market. They talk about the neutral rate of interest that they see, that expectations have been coming down. That's because the expectations for rate hikes have been coming down. And I think it's just because there's not that much of a demand for money at the moment. Also, lending standards are very high. On a small note, people have been talking about all this fear of a credit crisis again. It will not happen, in my view, the same way that it happened in 2007 and 8, although the provisions that would prevent that from happening are definitely not there. But I will tell you this from somebody who recently bought an apartment a few years ago. The mortgage lending standards are quite high, and the amount of there are no ninja loans anymore. That's the no jobs, no nothing. I mean, you could have had no savings, no jobs, no background, whatever. I mean, they were letting janitors buy $3 million homes, and they put them on what was then teaser rates. I don't want to get into the whole housing crisis that blew up in 2000, really blew up in 2005. Yeah, no income, no job, no nothing. I don't want to get into the whole credit crisis, but basically what they did was they put people into these loans. They had low interest rates and for a small period of time, and then when the interest rates rose, the balloon loan, they couldn't pay it and they just handed over their keys. And when you have a flood of inventory, we all know what happens to price. It plummets. Then I don't want to get into, then those loans had been packaged up and sold off, and then it was a whole contagion effect, but we're not going there right now. They talk about this case for rate hikes have strengthened, but they also talk about still some slack in the labor market and low inflation. And they also talk about, this is absolutely incredible to me. They're afraid that the employment rate is going to fall under the historical norm too far, and that they're going to have to hike rates faster later on. This was actually one of Rosengrant's arguments for wanting to be one of the dissenters in hiking. My answer to that is you don't have very much wage growth. When you start seeing wage growth, then start worrying about it. The unemployment rate, the headline number, is bullshit. It's a fake number. Everyone knows this. Even Bernanke, in speeches before he left as Fed chairman, mentioned that he knows that the number really isn't the number. My estimation, and I don't want to get into my back-of-the-envelope calculations for this, but unemployment probably right now is in the low teens, low to mid-teens, the real number. If you factor in people who are underemployed, meaning that they're part-time and want to be full-time, I mean, I don't even want to get into where that number could really be. And then some of that can start sounding a little conspiracy theorist, but I assure you it isn't the 4 and change or 5 and change that's being reported. It is significantly higher. The issue with regard to wage growth, technology is going to be putting pressure on that. So yeah, you might see a little uptick here and there, but it's still lower than people had in last June and July. So it's really not very impressive. They talk about that they said it would be reasonable to hike or reasonable to wait. They were worried about their credibility. And my answer to that was this, is if they hike and they're wrong, what's that going to do for their credibility? Hiking into a growth slowdown and you trigger a recession. What is that going to do for their credibility? It's going to do wonders, right? I mean, they're going to be pilloried. Oddly enough, this is what happened in the early 1920s. The Fed was worried about a stock market boom, and they held off on raising interest rates, and we all know how that ended, although the situation from now and then are very different. Yeah, I'll tell you, if I was involved in government and at the Treasury of the Fed, things would be run a lot differently. I'll tell you that. But anyway, so here's my thinking on with regard to the Fed and what's going to happen. Right? Are they going to hike or no hike? I'm very torn. I read through these minutes, and there is really, honestly, if this wasn't December and they didn't hike, and they mentioned, by the way, that they're not swayed by the calendar. I don't know if that's true or not. I mean, with these people, with what they say, if you read this and you took it on its face value, they will not be hiking. They would not be hiking based on these Fed minutes. They are moving closer to hiking, but this would not necessarily constitute a hike. I think they want to give themselves a little leeway with Brexit, which is really going to start taking effect next year, first quarter. We all know the last 2-3 years have been very weak first quarters. I really think the Fed would behoove themselves to wait. I don't think they should be hiking here. The data has been terrible. The employment is not where they need it to be. The GDP is not where they need it to be, and they don't want to start. The reason for hiking interest rates are for 2 reasons. A runaway economy and inflation. And none of that in their vernacular here is an issue. The Fed, based on these minutes, would not be hiking. Now here's the question. Will they hike or not? My answer to that is that, like I said, I'm really torn because I've said this all year that I thought we would have 1 interest rate hike this year, and I said I thought that would be in December, and now we're here, and now I feel a little funny saying I don't think that they're going to hike, basically that I've been saying that it's almost a dead certainty that they would hike in December. So I'm going to still stick with the idea that they may hike in December. The current probability for this, hold on, inflation. Someone was asking a question. The vote, by the way, was 7-3. So it is by no means, and it was Esther George, Loretta Mester. They would hike into a tsunami. These people are just brain dead. And then Rosengrant, who used to be a dove, and now he's sort of a hawk. I think it's going to be close. I think it's going to be really close, and I think that's what the market is freaking out about, that the Fed might hike for this credibility or whatever reason they concoct, that they may want to just do their one and done hike, and I believe they'll make it clear that they've already been out and they've been saying that they're not really looking to hike, that it's not every meeting, it's not going to be even necessarily every other meeting. The probability right now of the Fed hiking did fall today. It's below 60%. So you're teetering around that, this level of will they go or won't they go. The market, this is far from a done deal. I'm just going to say that right now. This is far from a done deal. The market is saying that it'll probably happen, but it's not 100% confident that it will happen. So what is going to be the key, in my view, for the Fed to hike or not? I think it's going to depend, and I don't know if anyone else is going to say this but me, it's going to depend where the dollar is at the time of the meeting. So the Fed, oddly, this is going to sound so crazy to people, but I assure you this is how it is. As the dollar rises, people are going to freak out, traders, that the Fed is going to hike interest rates because the dollar is rising, so that means the Fed is going to hike. Oddly enough, that rise in the dollar will freak the Fed out and they won't hike if it's very high, because a hike would exacerbate that problem. It would put the dollar up very high. No matter what anyone says, all of these politicians and so on and so forth, nobody wants a strong dollar. It makes, we already run a trade deficit. It actually, I believe, expanded recently. If they do that with the dollar, it will cause a big hurt on S&P earnings. The Fed is aware of this. They are afraid of a strong dollar, and with all of their jawboning and so on and so forth, I'm telling you, if the dollar is really strong, they will not hike. If the dollar recedes a little and gets more calm, they may start getting their spurs up. So in my view, this is all going to depend on the dollar. It's also going to depend on the market. If the market is very weak, they might not want to hike into that, going into the Fed meeting. And in addition, we need to see where the probability is. The Fed is very aware of the probability and what Wall Street expectations are, and from these minutes, it's been speculated that the Fed may or may not want to hike to shock the market. They do not want to shock the market. So if the market doesn't price in a hike, they will not hike. If they do, then they will. So that is my answer. I'm sorry it's not a definitive answer. I think it's really a bit of a toss-up here. They should not. In my view, they should not. Given the data and given these minutes of what they said, they should not. Will they? I can't necessarily tell you they will or they won't. That's the conundrum we're in. Anyway, how do we trade it? The answer is very, very simple. We go to levels. I'm going to talk. I talked a little bit about oil here. Oil has like I said, today's range, I think, is going to be the key because you had the inventory number above this. Anything in the 49s and higher, the risk is up in oil. Below 49s, we're going to see 45s and 46s and 45s. Probably pretty quickly. That would be a 50 MA test. It's currently 46.26, and the 100 MA is 46.55. So I think we would, if we fell, we would see that area. Oddly, oil was what kind of saved the market today. So why didn't the market go down today? I'll tell you first and foremost is I run some proprietary polls that you can all answer on Twitter. I also talk to a lot of people. I have a lot of followers on Twitter these days. Like 8,200 people, 8,231, but who's counting? If you're not following me on Twitter, by the way, my handle is @JustinPulitzer. And most people have been, I shouldn't say most people, but a lot of people have been really bearish. I can't even tell you how many times I got DM'd asking me about this 1987 chart that's going around and that the market looks just like this. I must have gotten at least a half a dozen, which is a lot. My view on this is that the underlying conditions that took place in 1987, which caused the 87 crash. By the way, the 87 crash, for those who don't know, didn't last very long. It only lasted a few months, and there was no recession in the economy. It was all technically driven by conditions of the market. The average Dow stock, I think, then was trading at like 30 times earnings. You had something known as portfolio insurance, which really caused the crash. I don't want to get too much into the nuances of that, but basically selling begot selling, and because of hedging for this insurance. So that was part of it, and interest rates were significantly higher then. We have interest rates that can't even keep their head over 2%. You don't have a credit crisis. There's no credit crisis happening now. You could take a look at the HYG. There is no need. There is nothing. Listen. There could always be some kind of an exogenous shock, but there is nothing right now, in my view, that is screaming imminent crash in the market. Will there be another crash at some point? Of course. Stock markets rallies always end. It always ends the same. I mean, there's always a crash at the end. Are we at that point? I mean, it depends. A lot of it is going to depend on the Fed. You know, if the Fed goes, if they don't go. I mean, we've been playing this game with the Fed now for years, right? They come up with reasons to hike, and then they walk away from them. They move the goalposts. That was actually one of the reasons why Loretta Mester If you want to hear why they didn't hike, by the way, Esther George was worried about moving targets. Like I said, that they focus on one thing and then they find some other reason not to do it. Mester was, what was her thing? She basically, that they're not in an emergency situation, and she was worried about the Fed's credibility. So could you type that again? Someone wrote something about Syria or something along the lines. And then Rosengren was worried about having to hike too fast if they wait too long. These are ridiculous answers. Honestly, these are very silly worries, in my view, given the situation with the growth. So my answer to that is, if there's going to be some type of a crash, it always shows in the credit markets first. We've pulled back off the high, but I mean we held the 50. We're roughly on the 50 MA right now. You're only a couple of points off the high. I mean, you have an upward sloping 100 and 200 MA that are quickly catching up. I mean, I would need to see a breakdown. I would need to see a few things for myself with regard to a quote-unquote crash. And I'm not talking about, a 5 or 10%, even a 15% pullback. Hold on, someone asked something. Wars spill over into the States. Someone was asking about the war in Syria. I don't see that being a crash event. We know that's a known kind of situation over there. The only way, if there was some type of an event where the U.S. got into it with Russia, that might be enough. That, I think, could cause a pretty decent pullback. Speaking of Russia, Putin ordered all of his ambassadors and citizens back to Russia, which is where there's speculation that he might be preparing for war. If he were to do something like annex the Ukraine, that would cause a market pullback. I don't think it would cause a crash, but I think you could see down 100 points in the SPOOs pretty quickly, maybe even 200. You got to always be on guard for these things. These are not things you can necessarily factor into, though. Someone asked if buying puts in 2018, is that a terrible move? I can't say that it is. I mean, the volatility is pretty low right now. You might want to do that when the VIX is low. What I would suggest if you want to do that is you pay for it. So you would buy those puts as like a hedge, a portfolio hedge we're talking about now. You buy those like later, the leaps of the 2000, let's say in this instance was 2018, and then you could use weekly puts or once in a while when you have a pullback in the market and you think it's going to bounce a little bit, you can sell those puts to offset some of the costs. So you keep taking in smaller amounts of premium to offset the larger outlay. So I do that quite frequently, where I have a play where I'm buying, let's say, calls or call spreads longer dated, and I'll sell weekly puts or some more near dated puts or even calls against it. So I don't think it's a terrible idea. I don't necessarily know if I'd be doing that as a outright directional play, but I can't say it's a bad idea. So that is my take on the Fed, the probability, and so on and so forth. I don't want to get too hijacked here because I do have to actually, believe it or not, unfortunately, we're going to have to end soon. But I do want to get in my levels with SPY and a couple of these stocks you mentioned earlier. Unfortunately, I have to go on a Shiva call. Sucks, right? I had a distant cousin that passed away, so I need to take a ride out to Jay-Z. Anyway, let's get into this SPY situation here. So I mentioned I thought that SPY was going to fill up the triangle to the 2100. In ES to 2100 to 2110, and we stopped roughly in between there. So that played out perfectly. With regard to SPY, you had a bit of what I would consider a look below and fail today. Why did that take place? One is that you've had a lot of very bearish sentiment. You had a heavily short overnight inventory, meaning the futures already were down a lot, with a lot of people buying it down or selling it down all night. And you had the big gap lower, and this wasn't, the first day. It had been down a lot prior couple days, and I think you had a lot of people who kind of panicked, sold the open. You had the move lower and then rebounded back into range. Today's close, I just want to see the low of yesterday's low of day was 213.01, and today's close was 213.01. So we were right basically at the low end of the range and inside the spike from the prior day. We looked below range, meaning the recent low, which was at 212.31. There was a reference breakout from 212.52. We sold off a little bit into the close today. I think that was a little bit of we had a poor high today, so I think you had a bit of a sell-off of that, and then the must-go-home flat crowd. Plus, you had basically you had the gap fill. So I think a lot of people use that to either initiate shorts. It wasn't a full gap fill in SPY, but it might have been an ES. I have to take a look. But it was close. Close enough for government work. I would say that I consider that gap filled. And I think that people either use that to short, you had to look in ES, you had to look into value, which backed off, and I think you had just people who had been playing long who wanted to take profits into the close. So my view is this, is today's range is obviously really important since it was the look below and fail. Anything below today's low is bad. I had said that if we lost that low, we would probably see into the 210s, 211s, and we got the 211s today. Those area, that range, the 210 to 211, and by the way, there's a gap fill at 209.53. That range, I don't know how easy it is going to be to break out of it at least the first time. I think it could consolidate there. I've said, though, that if we do get below and hold below the 212.31, I think you can double the range to the downside, and that measured move would roughly take you to the 200 MA. It would actually take you slightly below it into the 205s. It would be 205.02, and if you did a Brexit measured move, it would be 205.73. The 200 MA is currently 206.80. There was an old reference support around that area too, which is 206.76. So if things soften up and we start, losing the lows again, today's lows, I would think that you might want to target that range. Anything above today's high of day, I think we're going to go back up to the, maybe even as close to the 50 MA again. You had a look above the 50 MA a few days ago and failed, another retest of it that failed, and now we rotated from the top of the range to the bottom of the range, a look below and fell, meaning it went below price, there were no more sellers, and it came back up into the range. So we're not above the 100 MA, which is key. We did hold trend though, barely, albeit just barely. So this is how I'll trade it. If we get above today's high of day, like tomorrow or what have you, it's a right or right out long. Meaning that you would play if it goes higher, it's right, and if it falls back into range and starts getting below, let's say the 213s again, then I would where the close was today, the settle, then I would probably be either flat or even maybe a right or right out short. If we lose the body, we had a big wick today, so I'll just say this: if you lose the body of today's candle, which is just below the range, which is hold on, let me zoom in a little bit more here. What is this body low? 212.17-ish, around there. If you start losing that's today's body, then I think you could try right or right out short. I don't necessarily know you have to wait till the end of the range. So yeah, I either like it long over today's high of day or short below that 212.17-ish, which was for right or right out for the body, for a move down to the 209.53 gap fill, and maybe even potentially to the 200 MA. Anything, and I'm going to say this again, we had the look below and fail today, which is bullish, but we're still below the 100. We're still below the 50 MA. We're still below the 100 MA. You still have the 20 and the 10. We're below those major averages. When you lose the 100, it tends to want to test the 200. I'll tell you, I've seen this before, and this is just from experience. Often, the people who are short are right, but they don't make money on it, because you'll have something like today happen, they'll get squeezed out, and then the next day is when it happens, or the day after that is when it happens. Usually you get those types of moves though on I guess on you could have something on Friday if it's week on Friday. If we close week tomorrow, then I would assume that Monday would be a down day, and then maybe you have like the turnaround Tuesday or Wednesday type of a situation. It depends on how bloody these things get. I mean, and how quickly the move goes. This area, though, like I've said, has been a point of a lot of contention. So believe it or not, the look below and fail did not surprise me in the least because of the amount of time we had spent in that 210, 211 area, and it seemed to me like a logical area that the first time around wouldn't just sail through. So I'm just gonna stay with that trade. Anything above today's high of day, which again is 213.59, I'd rather be long than short, and anything below today's body, I would probably want to either be flat or short. And then if we got below today's low, you can add to it. So how do you like that for a short idea? Start the short below the body and then add below the low of day, or long over the high of day. Very, very simple. Keep it simple, stupid. Let's talk about some of these stocks here that people were interested in. I'm going to probably end in a couple of minutes, though, because I do have to leave. Apple, for the first and foremost. Apple behaved pretty well. It actually did fill the gap. Apple is a funny stock. Unless you're initiating a leg, it usually fills gaps. It's often very frustrating for people that way, both to the long and to the short side. I'd been a little greedy with this. I had some short puts on for quite some time, and I booked some of them today. They were really worn down. I always say I don't play for the last few whatevers, but anyway. Stock looks all right to me. I think as long as it can kind of hold over this 215-ish area, it's, in my view, all right. I mean, the 10-day is where? It's currently around the 214s, yeah. So as long as that area could kind of hold, I think it can see the 219, 220. I think that it's going to be a bit of it. I'm hoping my ideal setup for Apple is the shake and bake, where it doesn't make that full move. It comes back down, gets a channel low test and a 50 MA test, which is currently around 110. I don't know where it'll be when it does test. Maybe it would be around 112 or whatever. And then, maybe in a panicky fashion. I always love when Apple gets panicky ahead of earnings, and then it, gets the move up. But it seems to me that they delayed their earnings, and the Samsung situation, and the subsidies are back. If they can't beat this quarter, I mean, I don't know how they could. It seems like a layup that they'll beat the quarter. So if the stock runs ahead of the quarter, it could be a sell the news. But if it sells off ahead of it, I like to buy it. As far as right now, as long as it's above the 215s, it's all right. I mean, the stock looks just like it's going to be consolidating. I think kind of the maybe easier money ahead of the number has maybe been made, and like I said, I've been taking profits on short puts that I've sold, and I'm hoping that it comes back down and IV pops up again so that I can put them out once more. BABA, that is a bit of a mess. And I'm getting messaged here. I'm having a problem with my charts. This has started since one of the upgrades. It doesn't zoom in properly. Let me see. If I put this on manual and I say keep price zoom, it's still giving me a hard time. Anyway, hold on. Sorry. I've got to zoom out and then kind of drag it. It's really very annoying. All right. The BABA. All right, so BABA did actually what I thought it would do. It got close to the 110, which was our price target, 110.49-ish. I had said close enough. We got the pullback to the 50 MA, and it held. So here's the trade in BABA. If you're long, you can stay long against the 50 MA. A close below, in my view, would be a GTFO. Really, 98.45 would be panicky, or if you start getting below there, it's probably a bit of a problem. If you get above today's high of day, it was a successful 50 MA test, and it should rotate back up maybe into the 205, 206-ish. So I guess above high of day, you can try a right or right out long. And then I would probably use, I don't know if I would use the full 99 stop, but I would probably use like wherever the 50 MA is at the time. And then if you lose today's low, then I think that this could really start coming back and start really rattling the cages or shaking the trees, and we'd probably then see 96s and maybe even 93s. I don't think you're going to get the full gap fill ahead of the number, but you might get the shake and bake. It seems to me that BABA is probably doing well. I know there's some fear in China right now because of their exports or whatever, but most of BABA's business is domestic. And I think that they're kind of pulling an Amazon, like going into the web services model. I would, if BABA comes down ahead of earnings, I'd probably be more apt to play it long than short. If it rallies into the print, God be with you. I don't know what to tell you. It's moved a hell of a lot. So yeah, 50 MA. I like it long versus 50 MA, or not long or short below 50 MA. So that's the BABA. BABA, Apple. Bonds, the TLT. This is the key. This is really more key than I think anyone might know. The bonds are the Fed, really, right? That's the interest rates. So we had this has been really, really choppy and messy. It's still holding trend. It held really right where it needed to be. And today was actually up a bit. So I would say this. I like it long versus the 200 MA. Below the 200 MA again, to me, would not be good. So yeah, I was talking about that at the channel low and the 200 MA for a RoRo trade, and yeah, that's my story. I'm sticking to it. 200 MA plus, 200 MA below, no go. You could even try right or right out short. Wells Fargo. All right, so this Stumpf guy, I mentioned that after I saw him speaking that he was done. He just didn't know it, but he is now officially done. They brought in an insider to run the company. I think he was the CFO, Stoll or whatever his name is. Or it's not going to go over well, in my view. It's very tone deaf. But my problem, they have the quarter tomorrow. I think a lot of people want to just see that quarter. If the quarter's okay, the stock will probably have some kind of a rebound. But if the quarter's not good, it's probably going to take out the lows. I've been really looking for Wells Fargo to get down to the 39.40 to 40.07 level, where I would feel comfortable buying it and maybe even selling some out of the money puts. The pattern has been horrific. If you can, the problem for me with the stock is it's not been making any really higher lows. Today could have been the first higher low. So if you can get back up over with the earnings over the 45.92, then I would say it's probably going to try to fill the gap up to the 48s. So that's the story. I either like it over the last swing high and this sort of rut it's been in, the 45.92, or down closer to the 40.07 to 39.40. My big beef though with Wells Fargo is they're so worried about meeting regulations now, or they're probably not keeping their eye on their business about they're not cross-selling and doing all the things that we're helping them to beat. So I'm a little iffy about Wells Fargo. Anyway, I do have to get going. I'm sorry I don't have more time to spend on some of this stuff. I will cover the rest of these for the most part in the weekend review. If you missed this video or you want to catch more of it, you can see it on my YouTube channel. That's Justin Pulitzer Trades, and I'll post that now very quickly before I leave. So check that out. If you're not following me on Twitter, the handle is @JustinPulitzer. Anyway, have a great rest of the week. Just go by the levels, and cheers.